we had a strategy day at the end of January where we're in a presentation. We actually put out some quite hard measures that we've set for ourselves. We put out some cost saving targets that we'd like to see through simplifying our portfolio, a target of about 3 billion in that regard. And then, of course, strengthening our balance sheet's been another target we put out very, very openly in the market, saying we'd like to get our gross debt down by about 50%.
Welcome, ladies and gentlemen, to a new online interview here on Commodity TV. Today, I have the pleasure and honor to speak for the first time with Dr. Richard Stewart, the new CEO of Sibanye-Stillwater. Yeah, Richard, thank you very much for taking the time. Great to have you here for the interview, and greetings to Johannesburg.
Tim, thank you very much. Pleasure to be here. Thank you for the opportunity.
You're always welcome. Before we start, we have to disclose that this interview is being produced, published, and paid for on behalf of Sibanye-Stillwater. Yeah, Richard, about 2 weeks ago, you held your Sibanye-Stillwater Southern African Operations Capital Markets Day, and you spoke of a resilient strategy for a dynamic world. What specifically has changed compared to the company's previous strategy, and what are the 4 strategic priorities you are pursuing in this regard?
Tim, thanks very much. I think I'd probably describe it a little bit more as an evolution of the strategy rather than a change per se. I think if you're familiar with the history of Sibanye, and let me just give a very short soundbite. We're a company that started off life as a single commodity gold company in South Africa and have grown over the years to really a global footprint across multi-commodities. So it was a period of 15 years worth of rapid growth, predominantly through mergers and acquisitions. And that left us with a pretty substantial portfolio, but I dare say also one that became a little bit complicated perhaps, and with substantial organic opportunities, so substantial resources that we have. And I think the opportunity that we face today is really to look at the portfolio we've got and understand how we could make sure, number one, that it's operating to the best of its ability. How do we make sure that those operations we're getting maximum value out of them? And then ultimately, how we can simplify the balance of the portfolio. And we have the substantial resource base, where we see a lot of significant value that can be generated by investing in that. So I think the sort of strategy has almost been a bit of an evolution from one that's been, by necessity, very aggressive growth through M&A. It's delivered a substantial portfolio. And now we're really pivoting to say, how do we optimize the value of that portfolio and almost simplify it? I think when we look at the strategy, it's all about maximizing our margins, ultimately getting the fundamentals of the business right. So maximizing our margins, increasing our efficiency, and ultimately strengthening the balance sheet, returning value to shareholders, and ensuring our sustainability through growth. And that initial growth is organic. So the big pillars that we focused on is what we call performance excellence, and that's very much around maximizing the current business. We focus on simplification, both of the portfolio, and simplifying the portfolio obviously has the benefits as well around focusing our capital where we get our best returns. So how do we simplify the portfolio to optimize capital? And of course, it is around looking at organic growth, where we have some significant opportunities within the portfolio, and finally managing capital allocation. And I think, when you think of mining companies going forward, I dare say those that will be successful will be the ones that get their capital allocation right. And in our case, we're very focused on 3 aspects. The one is returns to shareholders. We see roughly a third of our capital going to shareholders, roughly a third on our balance sheet, and a third on future growth. So about returning value as well as sustaining the business.
Okay. So then let's come to the daily business. Your South African PGM assets are expected to continue creating value for some decades to come. Which projects would you say will make the greatest contribution to this long-term value creation?
Yeah. So Tim, we're actually looking at projects across the group, but let me start off with those PGM operations. So I think we've defined today within the portfolio sort of five core operations. That is our South African PGM operations, which are probably two-thirds of the business from an earnings perspective today. We've got our South African gold, our US PGM operations, our recycling in North America, and the Keliber project. Without a doubt, in terms of the resource base we've got, the South African PGM operations give us the best opportunity to invest within our existing resource base. And in total, we did outline in our capital markets day, we've got about 8 projects across that footprint that we can see significant value coming from. And the reason why we say it's such high value across these 8 projects is that they're brownfields, so very low risk from a technical perspective. It's very low capital intensity because we leverage off existing infrastructure. And then, of course, we've already got the teams and the systems and processes in place to be able to develop and mine these projects. They're also quite low cost. So they are shallow mechanized project, which means that, in fact, they complement our cost profile over time and actually make us a bit more cost competitive. So of those 8 projects, there are 4 that we have, or 3 that we've already taken to our board and approved. These are what we call the Siphumelele project, the Thembelani extension, and one of our surface projects. And the reason that those have been sort of chosen as the 3 immediate ones is because it is literally extensions from our current mining area. So we get cash flow from these projects on day one, and as we invest, so they ramp up over the coming years. There's a 4th one that we'd likely be taking to our board within the next 12 months to consider. That's called the East 4 project. And then the other 4 are still in feasibility phase, and we'll assess those as we go. But those from a strategic and a value perspective within the group would be our highest priority. We then also, of course, have the Burnstone project, though, a shallow gold project in South Africa. And I mean, I think with where we've seen the gold markets today, how many new gold projects do we have that have existing infrastructure and the opportunity to mine about 130,000 ounces a year below $2,000 an ounce? Those are very rare projects in today's environment. So that certainly features very high on our radar as well, and our priority list to develop. And then we are continuing to invest in our US PGMs. That's less about projects and more about driving down our costs to ensure that those operations are sustainable for the next 50 years. So between those, that would really be where our top priorities at the moment, and a lot of focus going, and where we see real value for the next 10 and 20 years.
Okay, you already mentioned the projects or the mines in the United States. So in recent years, you steadily diversified your operations, both geographically, but also in terms of the raw materials. So you stepped into battery metals or energy metals. And among other assets, the Stillwater mine in the United States, where you're currently mining at Stillwater East and East Boulder after Stillwater West was placed on care and maintenance in 2024. What specific market conditions would need to occur for you to ramp up production from Stillwater West again? And how quickly could you resume production of PGMs here in at Stillwater?
Yeah, Tim, I think I think for the US PGM operations, it's possibly a slightly more nuanced answer, and worth just looking at what those operations are at the moment. So, we had the 3 mines, as you mentioned: Stillwater East, Stillwater West, and East Boulder. Stillwater West was the oldest operation that we had there, and therefore one of the highest cost, and that just had to do with the size of the operation, the amount of time it took people to get to work faces, etc., because it is a 20-year-old mine. And therefore, that was one of the highest cost operations that we had. And for that reason, we placed the Stillwater West mine on care and maintenance when PGM prices came down. I think when we look at Stillwater as an asset, today we have about 40 years worth of reserve life, but the resource of that ore body could be mined for another 100 years. So for us, what's really important at Stillwater is, of course, mining in the US is more expensive than other parts of the world, both due to ESG requirements as well as labor costs. So for us, what's really important is to ensure that Stillwater is competitive on a cost basis and therefore can sustain any commodity cycles over the next 50 to 100 years. So we're currently investing into Stillwater East and East Boulder at the moment to get those costs down. And it's essentially a productivity investment. So it's a slight change, a modernization of the mining method that increases productivity and reduces costs. Once we can prove that that works there, then we would look at, can that be applied, that mining method, can it be applied to Stillwater West, and what would that cost? And then we would look at how to bring Stillwater West back on. So I think for us, it's less a question about, is there a incentive commodity price where we bring it back on, and more about how do we make these operations sustainable through any commodity cycle for the next 50 years and really deliver value for the long term from what is truly a world-class mining operation.
Okay. So, Richard, when I did my homework here for the interview, I had a look on your presentation of your Capital Markets Day, and there I saw that on the one hand, you expect geopolitical uncertainties to continue to shape the precious metals markets. But on the other hand, the outlook for platinum group metals remains positive despite the challenges in the automotive sector. Which scenario is currently causing you the most concern, and what makes you particularly optimistic?
Yeah, so that's a great question. So I think if we think about the short term at the moment, I think geopolitics has had a significant impact on the metals market in general. And some of that has been very positive, and some of it, I think, has got downside risk associated with it. So the positive side to me is I think it's brought back into focus the fact that mining is critical for our progression as society. We can't live without the metals that we mine, and particularly the critical metals that are going into energy in the future. I guess more recently you've also seen defense, etc., coming into it. But that has really put a spotlight back onto the scarcity of these minerals. And of course, we've seen this playing out in supply dynamics and supply protection of these metals across the world. So some of that is positive just in terms of recognizing the importance of metals and commodity markets. And I think that's a good thing. I think probably what concerns me the most is many of the metals, or certainly a metal like platinum group metals, like lithium that we also mine in Europe. These are metals that are exposed to industrial cycles and therefore global growth. And I think the biggest risk we face is with the current geopolitics we've got, and particularly when we start seeing trade wars and we start seeing real wars as we're seeing in the Middle East at the moment. That overall has a dampener on global growth. And those are the ultimate drivers for the demand for many of our metals. So that's the downside risk, I think, that we face in the short term that we need to watch carefully. But I do believe if we look at a sort of more medium-term view, and by medium-term, I'm talking 5 to 10 years, for the metals we exposed to, which is predominantly platinum group metals, as you've mentioned, but as well as lithium, we're very bullish on what we see going forward there. So platinum group metals in particular, 70% of demand comes from automobiles and internal combustion and hybrid automobiles in particular. And we still believe that market's going to be strong for several decades. It won't be the same levels of growth that it has been in the past, but it's certainly not going to disappear either. So those markets will still be around for a long time. And platinum group metals are so unique in their characteristics. They're physical and chemical. They're unique catalysts. We've got plenty of time to find new demand applications as internal combustion engine cars do slowly start to decline. And a lot of focus and effort is going into that by several of the companies today. So still remain very bullish on platinum group metals and where they're going in the medium term. But if anything, I think and I wouldn't call it a concern, but what we do focus on is the volatility that we've got in commodity prices in the short term, driven by a lot of the global uncertainty and geopolitics that's happening around us. And I think it's critical to position your business and your strategy to be able to manage through that volatility. And that's exactly what we've seen in the last 12 months.
Okay. So, Richard, let's come to Keliber because that's very important and of interest for us here, especially in Europe. Keliber is intended to provide, so you, Sibanye-Stillwater, with access to the European lithium value chain. What milestones must be achieved before Keliber generates positive free cash flow?
Mm. Yeah, Tim, thank you. And I think Keliber's an amazing project. I mean, I think when you think of the lithium markets today, you know, more than 70 or less than more than 70% of lithium refining capacity, which means we can mine it all over the world, but 70% of it gets refined and processed in China. And Keliber is one of the very few that's outside of that in the rest of the world that can refine. And it's the only current project in the whole of Europe that is a mine to market project. So we mine lithium in Europe, we produce it in Europe, and it can go straight into the battery value chain in Europe. And that's significant, not only from a strategic risk perspective in terms of obviously being an alternative source of supply for the European ecosystem, but also from an environmental perspective. Of course, transporting metals all over the world comes with a significant carbon footprint. And given that that is what lithium's supposed to be addressing, making sure you don't have to transport it is quite significant. So Keliber's got a lot of opportunities, and that's the real strategic value to us, as you've outlined. In terms of getting to cash flow positive, Tim, so the mine was completed in February of this year, the build. So the project was completed in February, and it comprises three sections. So it's a mine, we have a concentrator, and then we have the refinery. We commissioned the mine in February of this year. We took our first blast, and in fact, our mining has gone sort of ahead of our initial expectations. That's done very well. And the phase we're currently in at the moment is commissioning the concentrator, and we expect that to be commissioned over the next sort of quarter. Once we've done that, you can actually get to a saleable product. So most companies today sell the concentrate essentially to China, who processes it into a final product. And today, if we stopped at that point, commodity prices today, or prices for lithium concentrates, in the region of about $2,000 today, and we're producing it at about $1,000. So in fact, once we get to that stage, Keliber is in fact cash flow positive. And we should reach that position later this year. Of course, for us, the bigger question is the ultimate final product, which goes into the battery value chain. And that will come around when we turn on the refinery, and that will be a decision we'll look at later this year, driven by both the technical deliveries of the concentrator, but also by where markets are towards the end of the year. It's obviously been very volatile. And is that a point we want to turn it on, or do we want to delay the start of that a little bit? And that's where we'll get our real return on value. But from a cash flow positive perspective, we should start generating cash from our concentrates this year.
What role will Keliber play within the group in the long term? Is the project intended to become an independent earnings driver, or is it primarily intended to support strategic diversification?
Tim, great question. Look, I think firstly, let me say I don't think we have a strategy that's diversification focused. It's about value. It's about how we can create value and where we see that. So every project we have must stack up value-wise on its own merits. So definitely, I think it's important that Keliber will deliver positive cash flows and be able to contribute to the group's bottom line, and therefore to shareholder value as well. And that is a key priority, ramping that up. But importantly, yes, what it does do for us as well is we have a lot of automobile OEM customers in Europe. These are customers who have been buying our PGMs for several years. And this does allow us to be able to offer a more diverse product suite to those OEMs, now allowing them to be able to buy battery-related metals for electrification of vehicles. So it certainly does position us quite uniquely in terms of having that footprint in Europe, and being able to be one of the contributors to critical metals in Europe, where I dare say it's something that the European Union is looking at very closely at the moment, and how to diversify their risk away from single supplier sources, and we can be part of that solution. So it's definitely got a lot of strategic value to us, but it must also deliver value in its own right in terms of profitability and earnings, which we believe it will.
Okay. So let's come to some other mines and projects that we didn't name so far. And yeah, you mentioned it at the beginning of the interview. Your aim is to simplify the portfolio and focus on assets with the highest returns. Which specific assets are currently under review?
So Tim, I mean, I think some of the more obvious ones that we're looking at carefully is where we have over the years got minority sort of equity stakes within certain projects. And we've looked at those carefully to say, are there opportunities that we could add value to some of those projects? And let me give you a good example of one, which could be the Altar project. It's a copper project in South America, a fantastic project. We're a minority shareholder in that. It's currently undergoing feasibility studies, and it really is a world-class project. But it's big open-cast copper mining, which is not our expertise. We are more hard rock, labor-intensive underground mining operators. That's where our real core strength lies. I don't think we've got the strength to compete with the majors in big open pit copper mining in South America. So that might be a good example of one where we could extract more value for our shareholders by exiting that project for value than staying in as a minority or necessarily trying to execute on a project like that ourselves. So that's a good example of one where I'd say we are undergoing a review. There haven't been final decisions made, but we are definitely looking at how we could maximize value on an asset like that. We have the Marathon project, which is a PGM project in Canada. Same sort of story, not one that would likely fit our capital profile. And again, a minority stake, so probably could realize more value from exiting that one. And then we also have an interesting project in Australia at the moment, our zinc operations Century. That comes to an end in 18 months' time. But it's a project with some fantastic infrastructure in terms of processing plants, pipelines, port opportunities that could contribute to other possible projects in the region. In this case, in particular, there's a phosphate project we've been looking at. I don't think that phosphate is strategically a commodity we want to get into. So how could we realize value from that in the future? So those are some. Sandouville, the nickel refinery in France would be the other one, I would say, is not one where we specifically, it doesn't fit directly with the strategy today. So again, we're evaluating how we could maximize value. So those would probably be some of the examples I'd put out there, Tim. And then, of course, there are lots of small little projects we've got within the group where we need to decide, is it going to be part of a future strategy, or could we potentially realize value today? And it's about maximizing that value realization for shareholders.
Good, Richard. To conclude the last 20 minutes here, let's take another look ahead to the year, let's say 2030. What catalysts or milestones would you cite as evidence that your new strategy has been successful?
Mm. Tim, I think it's very much looking at those pillars that we put out and saying, have we delivered on them? And in fact, we had a strategy day at the end of January where we're in a presentation, we actually put out some quite hard measures that we've set for ourselves. And it's things like ensuring our operational excellence actually increases our current operations, and we put a target out there of 2.5% increase on output, just through productivity initiatives, which of course is, and that was in a gold equivalent basis. So of course that's quite substantial value when you take that through the bottom line. We put out some cost saving targets that we'd like to see through simplifying our portfolio, a target of about 3 billion in that regard. And then, of course, strengthening our balance sheet's been another target we've put out very, very openly in the market, saying we'd like to get our gross debt down by about 50%. So these are some of the hard targets we've put out that I think are good measurables to ultimately see, whether or not we're delivering on our strategy. But I think from a shareholder perspective, I would say the big measure that for me would signify success is that we have seen over the last few years we've traded at a relative discount to many of our peers. So looking at various trading multiples, we have traded a discount, and in engaging with shareholders and the market, many of the reasons for that, as we understand it, has been the issues we're trying to address in our strategy today. So it's been about having a stretched balance sheet, bit of complexity in the portfolio, not understanding the long-term growth opportunities of the company, etc. So many of those we are trying to address as part of the strategy. And I dare say for me, the ultimate measure would be of success is closing that gap on how we're trading relative to our peers. Of course, ultimately, we would want to become a premier premier stock and trade at a premium to our peers. But if we can just even close that gap, there's significant value there for our shareholders. And I think that's sort of the ultimate measure for me that we're being successful is closing that gap to peers.
Wonderful. That sounds great to me. Richard, thank you very much for these insights into your company, your plans for Sibanye-Stillwater for the next coming months and years. And it was an honor to speak with you about your company. And I'm really looking forward for the next interview that we will have soon, hopefully, and where we can discuss the first concrete results. Thank you very much for your time.
Wonderful. Tim, thank you for the opportunity. Appreciate that. Have a good day. Thank you.
Thank you. Yeah, ladies and gentlemen, that was Dr. Richard Stewart, the new CEO of Sibanye-Stillwater. And you heard it, Richard is bringing a real breath of fresh air to the company with a clear corporate strategy and 4 strategic priorities. Sibanye-Stillwater is set to be positioned on a broader footing, while at the same time becoming more efficient and flexible in the face of external influences. We are very excited and are already looking forward to our next conversation. Take a closer look at Sibanye-Stillwater. It's definitely worth it. Thanks for watching and bye-bye from Switzerland and from South Africa.